I'm Norm Wright with SKC Financial Group. In this update, we're breaking down what's really happening in the markets and economy, and more importantly, what it means for you and your money. In this video, we will cover three major forces that are influencing the markets today: the ongoing strength of technology stocks, a pickup in companies going public, and what higher long-term interest rates could mean for you as an investor. The S&P 500, which tracks the performance of 500 large U.S. companies, recently passed 7,500 for the first time. That is a notable achievement. At the same time, there are some important things to watch, including concerns about inflation, higher oil prices, and rising long-term interest rates. Let us take a closer look at each of these areas and what they might mean for your investments. To start, let us look at technology stocks and the role they are playing in pushing markets higher. A group of large technology companies known as the Magnificent Seven, which includes companies like Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, is once again leading the market higher. These seven companies now account for roughly 35% of the entire S&P 500. In other words, more than a third of the index is made up of just seven companies. That is a high level of concentration, and is something worth keeping in mind when thinking about how your investments are spread across different areas. The good news is that these gains are supported by solid business results, not just investor excitement. Earnings growth, which refers to how much profit companies are making, has been running well above its long-run average across the S&P 500. However, stock prices have also risen quickly, which means valuations have gone up. Valuation is a way of measuring how much investors are paying for a company relative to its expected profits. The S&P 500 is currently priced at about 21 times what analysts expect companies to earn over the next year. The historical average is closer to 16 times. For technology stocks, that number is even higher at around 24 times. Higher valuations do not necessarily tell us what the market will do in the short term, but they are a useful reminder of the importance of staying balanced and diversified across different types of investments. Next, let us talk about IPOs, which stands for Initial Public Offerings. An IPO is when a private company sells shares to the general public for the first time, allowing everyday investors to buy a piece of the business. Several well-known companies, including SpaceX, Anthropic, and OpenAI, have reportedly been considering going public. Many of these businesses have already grown substantially through private investment, meaning they have raised money from a small group of investors before ever being available on a public stock exchange. An IPO would open them up to a much wider pool of investors. For long-term investors, it helps to keep some perspective here. Stock market indices naturally add successful new public companies over time, which means investors can gain exposure to growing businesses without necessarily having to buy shares at the moment of the IPO. IPO activity also tends to cluster during periods when markets are strong and investment money is flowing freely. The dot-com era is perhaps the most well-known example. More recently, the period following the pandemic saw a surge in a type of IPO called a SPAC, or Special Purpose Acquisition Company, which faded relatively quickly. This history is a useful reminder that excitement around newly public companies does not always lead to quick gains for everyday investors. Institutional investors and company insiders are typically the first to participate in an IPO, often at better prices than those available to the general public. Finally, while stocks have been moving higher, long-term interest rates have also been climbing. The yield on the 30-year U.S. Treasury bond, which is a type of loan made to the U.S. government, briefly reached its highest level in nearly 20 years before pulling back to around 5%. A higher yield means the government is paying more to borrow money. Mortgage rates have followed a similar path. The 30-year fixed mortgage rate is now around 6.5%, which is above its long-run historical average. Rising rates make it more expensive to buy a home, raise borrowing costs for businesses, and can reduce the estimated value of future company profits. particularly for growth-focused companies that are expected to earn more money in the years ahead. That said, there is a positive side to higher interest rates for investors. Bonds, which are essentially loans made to governments or companies that pay regular interest, are now offering more attractive income than they have in many years. For long-term portfolios, this means that including bonds and other fixed income investments can play a meaningful role in both generating returns and helping to manage risk. We hope you found these insights helpful. If you'd like to learn more about any of these topics, please don't hesitate to reach out. We look forward to speaking with you.